This may be the most important video you ever watch on this channel. One reason being that money's a taboo subject and people just don't want to talk about it. The second reason I'll give you at the end of the video. Now, before I get started, this episode is not in my lane of expertise. I want to make that abundantly clear. It's the work of a financial advisor. I do not give investment advice. But if you don't consult a financial advisor, which is very often the case, you will likely never have this conversation. And you need to at least be exposed or introduced to this concept of extra dollars and opportunity cost in some way. Okay, so I'm not telling you what to or not to do. That's not my job. I'm not an investment advisor. Again, don't execute on any of this. Don't take it from me. Take it from an FA. I'm just going to tell you what they're likely to say, and I want you to at least get this thought brewing in your head. Okay, so when you have a mortgage, you have some disposable income to your hands after everything for the month is paid. And you've never had this before, so there's several things you can do with it. Aside from food, utilities, entertainment, childcare, whatever you spend your money on, there's about 4 categories I want to touch on outside of those things. They are, number 1, the mortgage, 2, your rainy day funds, 3, your higher interest debt, and 4, your 401ks, retirement accounts, and long-term investment vehicles. Based on your financial goals, an FA would likely tell you there is a right and wrong way to go about sending that extra money to. First thing, you always want to have some reserve funds readily available. After that, you're then left with sending those extra funds towards the mortgage, the 401k investments, and other higher interest debt. Okay, now, a lot of people think that the debt of a mortgage is a bad thing, okay? They want to pay it off as fast as possible under any circumstance, and they'll send extra money there first. Well, that might not represent the most efficient and effective thing to do with that money for several reasons. Because, one, if you have other debt with higher interest rates, it's costing you more per day to hold on to that debt dollar for dollar that you have tied to those rates. I've talked to so many people that locked in a 2.5% or 3% rate during the COVID era and asked them how they were doing with their lower rates and how happy they were with it. And I was shocked to get some of the answers that I got. I remember talking to a family member one time. She was thrilled about how she was paying down the mortgage balance so quick. And I was like, wait a minute, you got a sub 3% interest rate. How do you know that's the best thing to do for yourself and your future finances? Okay, look, you might have been drilled that by your parents or other people in the past that the mortgage is bad. You want to get rid of it. But earlier generations had to pay off mortgages that had interest rates of 8 to even 20%. So maybe that was their higher interest rate debt, which would then make perfect sense for them in their scenario, but maybe not yours. Okay, so just when you're paying debts off, be mindful of what's got a higher rate. That's the first big thing I want you to get out of this video. And finally, number 2, the second big thing I want you to get out is that I don't want you to ever neglect your 401k or retirement investments, which are supposed to grow at 5 to 7% over the long run. You might not want to be that person that beats down that mortgage balance so aggressively in 10 to 15 years because you didn't like the idea of the mortgage in the first place. And let me tell you why. It's because had you sent that money instead to your retirement nest egg, you could then have this huge portfolio paying you out all these dividends off a distribution that could be income for you for the rest of your life. But too late, 10 to 15 years down the road, you can't go back in time to fix that. The time value of money can make you so much more money in the future if the earlier you invest. Okay, and by the way, what do I mean by a distribution? Well, that's what you get paid off your investment. Okay, simple math tells us that a 5% distribution on a $5 million investment account, okay, so what you've saved up over many years, that would pay you $250,000 a year or over $20,000 a month. That's assuming the investment stays at 5 million, which all stock accounts or investment accounts can go up or down in value over time. And imagine if you built up a side investment account to just $1 million. That would in theory pay you close to $50,000 a year or over $4,000 a month at that 5% distribution rate. And I say 5% because that's a pretty common distribution percentage. But just think about it. 10 to 15 years down the road, your income will have probably increased substantially. And that mortgage payment probably never rose during that time if you never increased the balance by taking a cash out refinance. So you could have far more disposable cash to yourself down the road, which would make it much easier for you to pay the mortgage if you didn't pay it down so aggressively by then. And on top of that, if you were sending a healthy amount of money towards your investments, you'd have this big account growing for you year by year. Now that's, assuming a healthy and stable financial market over time. Now, depending on where you are, you may not have these priorities. Okay, the closer you are to retirement, the more you'll want to pay that mortgage balance off because you're not going to want to have a mortgage in retirement. But the younger you are, the more incentive you'll have to put the time value of money phenomenon to work in your favor, because you'll then have more time for the money to grow larger and larger with compound interest. Just sit and cook in that account over years. Now, with all that being said, I'd like to kindly ask you to share this with somebody who's going to buy a house in the next year or two, okay? Loan officers don't take the time to teach you these things. They just make sure you qualify, then to make sure that they get their commission. This will help your friends out so tremendously. Trust me, it's entire channel. Guys, thank you so much for watching. And in the comments below, I want you to tell me which of those 4 places you would put your money first in order. Number 1 being your biggest priority, number 4 being your least. Thank you.